You know, every single company out there, whether it's a tiny startup or a massive global corporation, has a story. A story about its wins, its struggles, its overall health, and its potential. But here's the thing. That story isn't written in words. It's written entirely in numbers. And today, we're going to learn how to read it by diving into the language of business itself, financial accounting.
So how do you read that story? I mean, think about it. Maybe you're looking to invest in a company, or you want to work for one. Or hey, maybe you're even dreaming of starting your own. Whatever the reason, understanding its true financial position is absolutely critical. And the key to unlocking all of that? Yep, it's financial accounting.
All right, first things first, let's get right to the heart of this language of business. What exactly is financial accounting, and why does it matter so much for understanding how a company actually operates? Okay, in the simplest terms, financial accounting is how a company officially tells its story to everyone on the outside. We're talking about investors, banks, regulators, anyone who has a stake in the business. It's the standardized process of recording, processing, and then communicating all of its financial data.
Here's a great way to think about it. Financial accounting produces a company's official report card, or you could call it an annual health checkup. It shows exactly how the business performed. And what's so important here is that this isn't based on someone's opinion or gut feeling. Nope, it's a factual summary built from every single financial transaction.
And this is basically how it all flows. It starts with the raw data. Every sale, every purchase, every single bill. That data is then systematically recorded, processed, and sorted. And what comes out the other end are these clear, summarized reports that give incredible insight into the company's performance. It's a journey from just a bunch of numbers to real, actual understanding.
Okay, so let's get into the building blocks. There are two main ways of recording all this data, and it all comes together in four crucial documents that, when you put them together, tell the company's complete financial story.
So it all comes down to timing. On one hand, you've got cash accounting. It's super simple. A transaction only gets recorded when cash actually changes hands. You get paid, you log it. But on the other hand, accrual accounting gives a much truer picture. Imagine you do a job in December, but don't get paid until January. Well, accrual accounting records that sale in December when you earned it. That's why it's the standard for most large companies. It shows what's really happening in the business, not just what's in the bank account today.
All of that accounting data gets boiled down into these four key statements. I want you to think of them as the four essential chapters of a company's story. You can't just read one and get the whole picture. You really need all four to create a complete, three-dimensional view of the business.
First up is the balance sheet. The key word here is snapshot. It's like a financial photo of the company on a single day. On one side, you have assets. That's everything the company owns. On the other, you have liabilities and equity, which is everything it owes to others and to its owners. And here's the magic part. It must always balance. What you own is always funded by what you owe.
Next, we have the profit and loss statement, or P&L. If the balance sheet is a photo, the P&L is a movie. It shows you the company's performance over a period of time, like a quarter or a full year. It tracks all the money coming in from sales, that's the revenue, and subtracts all the costs of doing business, the expenses. What's left at the end is that famous bottom line, the net profit or loss.
The cash flow statement is the ultimate reality check. It answers one simple question: where did the cash actually go? See, a company can look profitable on its P&L statement but still run out of cash. This statement follows the money, tracking cash from three key areas: its day-to-day operations, its long-term investing, and its financing activities, like taking on loans. It tells you if the company is generating enough real cash to survive.
And finally, the statement of equity shows how the owner's piece of the pie changes over time. It starts with the owner's stake at the beginning of the period, adds in any profits the company kept and reinvested, and subtracts any money paid out to owners, like dividends. The result is the new, updated ownership stake. It tells you if the value belonging to the owners is growing or shrinking.
Okay, so we know what it is and how it works, but why go through all this trouble? Let's talk about the purpose and the incredible power that comes from doing all of this well.
So why do all this work? Well, the purpose is really twofold. First, there's the stuff you have to do. You're legally required to do it for tax and compliance reasons. But the real power comes from the want to. It creates a reliable system of record that lets you measure profitability accurately and gives everyone, both inside and outside the company, the hard data they need to make smart decisions.
And the advantages are huge. By keeping a clean, reliable history, you help prevent and identify fraud,
And you give everyone an honest view of the company's health. But most importantly, that historical path allows you to look forward, creating a roadmap to project future growth. You're turning the past into a plan for the future.
Now, as powerful as it is, financial accounting isn't a perfect crystal ball. To truly understand it, we need a balanced view. Let's look at what it doesn't do and how it differs from other types of accounting.
So, what don't the numbers tell you? Well, first, they ignore crucial non-financial factors, like the quality of the leadership team or a new competitor entering the market. Second, it's all historical. It tells you what happened yesterday, not what's happening right now. And here's a huge one to remember. Assets are typically recorded at their original cost, not their current market value, which can sometimes paint a misleading picture.
This brings us to a key distinction. Take a look here. Financial accounting is for outsiders, like investors. Its purpose is to show the big picture health of the company. Cost accounting, on the other hand, is for insiders, like factory managers. Its whole purpose is to drill down and figure out the exact cost of making one single product. Management accounting is also for internal use, but it's much broader than just costs. The biggest difference is the rules. As you can see, financial accounting is legally required and has a very strict standardized format. Management accounting is completely optional and flexible. It's whatever the leadership team needs to plan for the future.
So after all that, what's the one thing you should remember? Let's boil it all down to a single takeaway. It really comes down to this. The true power of financial accounting is that it helps a company find the real financial value of its profits and losses. It's all about replacing subjective guesswork with objective facts. And that leaves us with a final thought. We've just covered the basic grammar of the language of business. So the next time you look at a company's report, remember you have the tools to read their story. The only question is, what will those numbers tell you?